Turning now to price developments, disinflation has been accelerating over the last 2 months. Headline inflation fell to 2.2% in August 24 and is expected to drop further in September, mainly on account of falling energy costs. We have seen already some numbers coming down for France, for Spain, for Italy, and more recently for Germany today. And that confirms this point. Core inflation, taking energy and food out, edged down to 2.8% in August, driven by a decline in goods inflation that outweighed an increase in services inflation. The indicator of domestic inflation, which only includes items with a low import intensity, remained high in August as wages continued to grow at an elevated pace. At the same time, the overall growth in labour costs has been moderating in recent quarters, and profits have been buffering the impact of higher wages on inflation. Looking ahead, inflation might temporarily increase in the fourth quarter of this year as previous sharp falls in energy prices drop out of the annual rates. But the latest developments strengthen our confidence that inflation will return to target in a timely manner. We will take that into account in our next monetary policy meeting in October. And again, you have indication about inflation development in the left bottom corner of the term sheet that you have. The ECB staff projections from September foresee inflation to average at 2.5% in 24, 2.2% in 25, and 1.9% in 26. So let me now turn to our monetary policy stance, which is the first topic that you've chosen for today's hearing. I would contend that we have come a long way in the fight against inflation. Remember, in October 22, inflation was at 10.6%. 1 year later, by September 23, the last time we raised interest rates, it had dropped by more than half, down to 5.3%, 5.2%. The decline in inflation and the anchoring of long-term inflation expectations showed that our strong monetary policy response was bearing fruit. Then, after 9 months of holding rates steady, we saw inflation halve again. So 10.6, 5.2, we were down in June at 2.6 when we started lowering interest rates, as you indicated, Madam President. The new data available at the time of the September Governing Council meeting reinforced our confidence in the timely return of inflation to our 2% target. We therefore lowered the rate on the deposit facility, which is the rate through which we steer the monetary policy stance, and we lowered it by another 25 basis points. We are now down to 3.5% for the DFR. We are determined that inflation will return to our 2% medium-term target in a timely manner. We will continue to follow a data-dependent approach in determining the appropriate level and duration of restriction, focusing on the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. Policy rates will be kept sufficiently restrictive for as long as necessary to achieve our aim, and we are not pre-committing to any particular rate path.